financial accounting students. Today we're going to dive into Chapter 3, which I hope is going to reinforce what you've learned in Chapters 1 and 2, but we're also going to get deeper into the double entry accounting system. Specifically, we need to start by learning about T accounts and the use of debit credit terminology. Thus far, we've been using terms increase, decrease, add, subtract, it goes up, it goes down. And those are all true, but we want to change that into proper accounting terminology, which is debits and credits. So first we need to take a look at a T account. We call it a T account really only because it looks like a T, no other complicated reason. We're going to have a T account for each individual account. So rather than having a separate column, each account is going to have its own T account, and that includes our assets, liabilities, equities, including the temporary accounts under retained earnings. They're each going to have their very own T account. So then we need to learn about debits and credits. Students always want to know, well, what do debits do? Do they make everything go up? And what about credits? Do they make everything go down? What does that mean? So the answer to that is, well, it depends. Debit and credit do different things on opposite sides of the equal sign. So in our ALO, assets equal liabilities plus equity. A debit on the asset side is an increase, while a debit on the claim side, the liability and equity side, is a decrease. On the asset side, credit is a decrease, but on the claim side, liabilities and equity, credit is an increase. So that's what the pluses and minuses here are indicating. So what we need to know is that on opposite sides of the equation, debit and credit do opposite things, right? So if we have a big line through the middle, they do opposite things on opposite sides of the equal sign. And if you think carefully, throwing in this fact at the bottom, in every transaction, the total dollar value of all debits equals the total dollar value of all credits. So transaction by transaction, debits must equal credits. We also know that ALO has to be in balance. Assets have to equal liabilities and equity. So if we have a debit on the asset side, making the asset side go up, then we're going to have a corresponding credit on the liabilities and equity side, making the liabilities and equity side also go up. So debits will equal credits and assets will stay in balance with liabilities plus equity. So by the nature of our accounting equation, the way it moves up and down together, we have to have debits equal credits. So in every transaction, the total dollar value of all debits will equal the total dollar value of all credits. So here's the same kind of information, a slightly different view. So for assets, debit is an increase, while liabilities and equity, debit is a decrease. For assets, credit is a decrease. For liabilities and equity, credit is an increase. And here they give it to you in words. So now we've looked at it several different ways. The trick is being able to really get that solid in your brain. So I want to share with you the method that I use in terms of remembering the rules of debits and credits. So how I do it, I use this little device that is aid and lick. Aid and lick is everything you really need to know about debits and credits. And what that stands for is assets increase. That's really sloppy. Increase with a debit. And liabilities. And I don't want to leave out owner's equity. So liabilities and owner's equity increase with a credit. That's how I figured it out when I was an accounting student in my first semester of accounting, and it's worked for me ever since, and I've shared this with countless students. So I use aid and lick, assets increase with a debit, liabilities and equity increase with a credit. And if we know how to increase, then we should be able to figure out how to decrease, right? It's just the opposite. What I want you to think about is how does that apply to the accounting equation? So if we draw out our accounting equation, assets equals liabilities plus owner's equity, and then under owner's equity we have common stock and retained earnings, and under retained earnings we have dividends and net income, and then we know net income is revenue minus expense. Okay, and then I'm going to add a few markings, hopefully you remember. So when we have more and more revenue, that's causing net income, retained earnings, and owner's equity to all increase. When we incur more and more expenses, that's causing net income, retained earnings, and owner's equity to decrease. And when we pay out dividends, we're causing retained earnings and owner's equity to decrease. And then just as a reminder, of course, this is our income statement. Okay, so I wanted to talk about this accounting equation, my allo tree, in terms of debits and credits. So let's say that our asset side is going up, so that's a debit. So that would mean that we need to have a credit somewhere on the owner's equity side. So something would be going up under liabilities or owner's equity. It could be something like revenue, it could be common stock, or we could have a liability that's increasing. But I want you to think about what it means when we incur, say, an expense. The expense itself is going up, but when we incur an expense, what is happening to owner's equity? When we incur an expense, it's going to cause net income, retained earnings, and owner's equity to all go down, so that's a debit. When we pay out dividends, it's going to cause retained earnings and owner's equity to go down, so that's a debit if we're thinking of the rules aid and lick. What about when we earn revenue? When we earn revenue, it's going to cause net income, retained earnings, and owner's equity to go up. So that's a credit. So I didn't give you the specific rules of debits and credits for revenue, expense, and dividends, but I want you to think through whether they have a positive or negative relationship to owner's equity. So when we earn revenue, owner's equity is going up with a credit. When we incur expenses or pay out dividends, we're causing retained earnings and owner's equity to decrease with a debit. So we'll get some practice doing that as we go through our transactions today. We're going to be looking at transactions for Collins Brokerage Services. And as we do this, I want to be careful that we remove our old terminology of increase and decrease, and we replace it carefully with debits and credits. So first we have Collins Brokerage Services. They began the period with the following balances: $5,000 in cash, $4,000 in common stock, and $1,000 in retained earnings. So here we encounter the first question: how do we know if those are debits or credits? Well, here's the answer. It's this thing called normal balance. So first of all, when we read those numbers, we assume that those are all positive numbers, that we have positive $5,000 in cash, positive $4,000 in common stock, and positive $1,000 in retained earnings. It didn't indicate negative, so the safe assumption is that those are positive numbers. And therefore, to understand the account's normal balance, we simply apply aid and lick. The normal balance is whatever we have to do to increase that account. So assets carry a normal debit balance, and liabilities and equity carry a normal credit balance. The exception to that would be expenses and dividends. Those accounts are typically going to have debit balances because they're essentially negatives to retained earnings. So we'll deal with that in just a minute. But if we were to put this into T account form, we see we've got cash with a debit balance on the left side. Okay, and again, debits are always going to be on the left, credits are always going to be on the right. That's just something you need to know. Under common stock, we have 4,000 on the credit side, and under retained earnings, we have 1,000 on the credit side. So we've got a debit of 5,000 equals credits of 4,000 plus 1,000. And we also see that we're in balance overall. 5,000 equals 4,000 plus 1,000. And then they show it down here at the bottom in traditional accounting equation form, where the top model is showing accounting equation, but with T accounts drawn in as well. So that's the concept of normal balance. Make sure you study that and practice it. It's an important one to understand what balance something normally has. And if you need a quick reminder, the answer is aid and lick. Assets are going to increase with a debit, so they have a normal debit balance. Liabilities and owner's equity are going to increase with a credit, so they have a normal credit balance. All right, so event 1, January 1st, year 2, Collins acquired $25,000 from the issuance of stock. So we know that cash is going to go up and common stock is going to go up. I'm hoping you recall that from chapter 1. So now we just add debit credit terminology to that. So that's a debit to cash and a credit to common stock. In our accounting equation format, it might look more familiar and comfortable to you. Cash is going up 25,000, common stock is going up 25,000, and our cash flow type, keep practicing those cash flows, our cash flow type is FA, financing activity. Next, Collins purchased $850 of supplies on account. So thinking of what accounts are affected, when they say on account, right there, on account means that we're going to pay later. So we need to be able to decipher, is that accounts receivable or accounts payable? So I'm hoping that you figured out it's a liability, accounts payable. It's what we owe to somebody else. So we've got supplies, the asset, going up with a debit. And then our liability account, accounts payable, going up with a credit. So we debit supplies, credit accounts payable. And in accounting equation format, we see 850 under supplies equals 850 under accounts payable. Event 3, Collins collected $1,800 as an advance to provide future services over a 1-year period starting on March 1st, year 2. Do you remember what that's called? We received money, but we haven't done the work yet. Hopefully you said unearned revenue. And if you remember, unearned revenue is a liability. It's a liability because we owe somebody that work. We have an obligation to perform that work, or at a minimum, we need to give them their money back. So until we've actually done something to earn that revenue, it remains as a liability called unearned revenue. So in this transaction, they tell us that we collected $1,800. That means cash in. So that is a debit to cash. Cash is going up. And then it's a credit to unearned revenue. Our liability, unearned revenue, is going up with a credit. And in accounting equation format, we see 1,800 equals 1,800, cash and unearned revenue. And our cash flow type is OA, operating activity. Remember, it doesn't matter when we collect money from a customer, whether it's in advance, on time, or after the fact, it's still money in from a customer, and therefore it's OA. So this transaction is a deferral transaction. And in our brains, we should be thinking, well, later on, we're going to have an adjusting entry to recognize the amount of that unearned revenue that we have in fact earned between now and year end. So we will see an adjusting entry for the earning of that revenue later on. Event 4. During year 2, Collins provided $15,760 of services on account. Now, what does on account mean? We did work, but our customer hasn't paid us yet. So we wish we were getting cash, but we're not. Instead, it's going to be a different asset, accounts receivable. So we're debiting accounts receivable, $15,760, and we're crediting consulting revenue. And notice that I want to be really careful that we're crediting consulting revenue. We're not crediting retained earnings. In T account format, we're really not going to be using retained earnings outside of our closing entries. And we'll talk about closing entries in just a little while. But we need to make sure we're debiting and crediting the exact temporary account. And then later we'll close it into retained earnings. Under our accounting equation format, we see accounts receivable going up. And then this I thought was kind of funny. Normally this should say common stock plus retained earnings, but they actually wrote consulting revenue there, which that is the retained earnings column, but specifically it's consulting revenue that is receiving that credit directly. And then we see revenue on the income statement is creating net income of $15,760. Event 5, during year 2, Collins paid $26,000 cash to purchase land. So this is an asset exchange. We've done this type of transaction before. So land is going up with a debit and cash is going down with a credit. So it's debit land, credit cash. And in accounting equation format, that should look familiar. Land goes up, cash goes down. So our debits do equal our credits, and we are in balance. We've got 0, right? Negative 26,000 plus 26,000. We've got 0 on the asset side and then nothing on the liabilities and equity side. So it is in balance. It's an asset exchange, and our cash flow type is IA. We're using our cash to invest in a long-term asset, so that's IA. All right, event 6, we paid $1,200 cash for a 1-year insurance policy with coverage starting on August 1st. All right, so we pay out cash. So cash is going down, assets are going down. So that is a credit to cash and then a debit to our asset prepaid insurance, right? So back in chapter 2, we learned about prepaids. We don't expense the whole thing now because the matching concept tells us we want to expense it in the period in which it's incurred. So some of that 1-year policy belongs to this year and some of it's going to belong to next year. So we put it all in as a prepaid, and this is a deferral. We're deferring the expensing of that insurance until our year-end adjusting entry. So again, an adjusting entry that's going to result in, a deferral entry that's going to result in a year-end adjustment. So debit prepaid insurance, credit cash, and then in accounting equation format, we can see this is an asset exchange with cash going out, cash going down, prepaid insurance going up, and it's OA. Our prepaids, whether we pay our insurance early, on time, or after the fact, or our rent or our advertising or whatever prepaids we might have, the timing of when we pay it doesn't change the nature of the cash flow. Insurance expense is going to be an operating activity. So here we're paying it in advance and it's still OA. Number 7, collected $13,400 from accounts receivable. So we have cash going up, so that's a debit to cash, and accounts receivable going down, which is a credit to accounts receivable. Again, another asset exchange. Cash is increasing, accounts receivable decreasing, and our cash flow type is OA. Again, it's money in from customers. Event 8, paid $9,500 for salaries expense. Okay, so we're paying out cash. So cash and therefore assets are going down. So that's got to be a credit, right? Assets are decreasing with a credit. And then we know because we already have a credit, we must have a debit on the other side. But I want you to be comfortable with why. So when we record an expense like salaries expense, we're causing net income, retained earnings, and owner's equity to all decrease. So a decrease to owner's equity is going to be a debit. So a decrease to owner's equity is a debit. But look at how we record that. So under equity, we have our T account for salaries expense. and it's showing it as a plus 9,500. So it's increasing salaries expense, but remember, salaries expense and any expense has a negative relationship to net income, retained earnings, and owner's equity. So it carries a normal debit balance. We are in fact increasing the expense account, which is causing equity to go down. So debits equal credits. We're crediting cash, debiting salaries expense, and we're in balance. Minus 9,500 on the asset side, minus 9,500 under retained earnings on the equity side. And again, remember, when we record these into specific T accounts, we don't use retained earnings. We have to use the specific temporary account, in this case, salaries expense. And our cash flow type is OA. Normal part of our operations is to pay our salaries. Event 9, paid an $800 cash dividend. And again, a lot of the same thinking as the previous transaction. So cash and therefore assets are going down. So that's a credit of 800. And then over on the equity side, we're going to record dividends. So if we're paying dividends, dividends is going to cause retained earnings and owner's equity to go down. Now, we already knew that we were going to need a debit because we have a credit to cash. We knew we needed a debit, but I want you to feel confident in your ability to explain why. And it's because of that negative relationship between dividends and equity. So dividends themselves are going up, which is causing equity to go down. In our accounting equation, we see cash going down and therefore retained earnings going down. And this time, nothing on the income statement, which reminds us that it's dividends, because dividends don't affect the income statement. And the cash flow type is FA. So these last two transactions, one was an expense, one was a dividend. Hopefully you can think through and explain it. In your own words. But keeping in mind, if we already know that we're crediting cash, we know we need a debit on the other side. So that helps us to figure it out initially. Couple other things that might help. When it comes to expenses, I like to say, when in doubt, debit the expense account. When in doubt, debit the expense account. So if you're ever unsure about what to do to an expense account, 99% of the time, the answer is going to be debit. And when it comes to dividends, debit dividends, debit dividends, debit dividends. I really can't think of a good reason that you would be crediting dividends other than maybe fixing a mistake. There's a couple times when you might find yourself crediting an expense, but those are kind of rare exceptions. So with both of those, we should feel pretty confident with choosing debit, but I do want you to also get comfortable with explaining why. Number 10, paid $850 to settle accounts payable. So we're using cash to pay these bills. So that's a credit to cash and therefore a debit to accounts payable. Both sides are going down, an asset use transaction. Both sides go down, a credit to cash, a debit to accounts payable. And in our accounting equation format, we see cash going down, accounts payable going down, and our cash flow type is OA. We're paying off our normal operating bills. 11. During year 2, Collins recognized $1,900 of other operating expenses on account. What does on account mean here? Do we owe money to someone, or does someone owe money to us? Someone owes money to us, right? No, we owe money to someone. Which one is it? You need to be comfortable with this. We recognized expenses on account. That means we're going to pay someone else later. I want you to be careful in thinking through this. I'm seeing a lot of students struggle with the difference between accounts payable and accounts receivable. So again, this one is accounts payable. We owe money to our vendors. We're going to pay them later. That's a liability, an obligation. Where in contrast, we could provide services on account, which means our customers owe money to us. That's a receivable, an asset. So keep practicing on those. So again, $1,900 of other operating expenses on account. So what's going to happen? Well, we've determined it's accounts payable, and that's going to be going up. The liability is going up with a credit, and then we need to expense it now. We need to expense those other operating expenses in the period that they belong to. I know they put advertising expense here on the T account. It should be operating expenses. Doesn't matter. It's an expense account. It's going up with a debit, which is causing equity to go down. So when we increase our expenses, net income, retained earnings, and owner's equity are all decreasing. So in accounting equation format, we see it's a claims exchange. Nothing happening on the asset side, but we have liabilities going up and retained earnings going down. All right, adjusting entries. Adjustment number 1. As of December 31st, year 2, Collins had earned $1,500 of the $1,800 of revenue it deferred. Well, look, they did the math for you. That was awfully nice of them, but I can promise you in your homework, in your quiz, on your test, I'm not going to be doing the math for you. So let's take a look at how they got the $1,500. They took the $1,800 of unearned revenue. They divided it by 12 months because there's 12 months in a year, last I heard, and that's $150 per month. Then we need to look at how many months went by. So we received that unearned revenue back on March 1st. So from March 1st to year end is 10 months, not 9 months. Be careful, count your months on your fingers if you must. So from the beginning of March to the end of December is 10 months. So we take $150 times 10 months. We've earned $1,500 of that unearned revenue. Here's a question. What's left in unearned revenue after this? $300. 2 more months, January and February of the next year, times 150. It's always good to be able to reconcile in our head. So we've got 300 remaining as unearned. 1,500 has now been earned and is going to move over to real revenue, in this case, consulting revenue. So we're decreasing the liability with a debit of 1,500, and we're increasing our revenue, consulting revenue, with a credit, which is then going to make net income, retained earnings, and owner's equity go up. So we've got a claims exchange transaction. As a reminder, on adjusting entries, there's never cash involved, and the recognition of revenue and expense is always involved. The purpose of adjusting entries is to try to match our revenue and expenses into the correct period. And so that's exactly what we're doing here. We see unearned revenue, the liability going down, leaving a remaining balance of $300 in that account. But we've got minus $1,500 there equals plus $1,500 in retained earnings. So we're in balance. We've got nothing on the asset side. We have a claims exchange, negative $1,500 plus $1,500 equals nothing on the liability and equity side. And we see our revenue going up. So we've moved it from being unearned revenue as a liability to real revenue on the income statement. Adjustment 2. As of December 31st, Collins had $800 of accrued salaries expense. So that word accrued, remember that means recognize before realize. So we need to recognize the salary expense now because it belongs to this period, year 2, and then we're going to pay it later in year 3. So our liability, salaries payable, is going up with a credit, and our equity account, specifically under retained earnings, we're going to have salaries expense, so that's an expense account. So we're going to increase salaries expense with a debit, which is going to bring down net income, retained earnings, and owner's equity. So again, this is a claims exchange with our liabilities going up and our equity going down. In accounting equation format, we see our liability increasing by $800, salaries payable, and our retained earnings is going to go down by $800 because we are incurring that expense. Adjustment number 3. Collins had used $500 of the $1,200 of insurance coverage that was prepaid in event 6. Now again, they've done the math for you, but like I said, I promise on your homework, on your quiz, on your test, I'm not going to do the math for you. So let's make sure we're solid in how they're coming up with 500. So they take the $1,200 of prepaid insurance, divide it by 12 months, and that's $100 per month. And then that happened on August 1st. So from August 1st to the end of the year, beginning of August to end of December is 5 months. So we take $100 per month times 5 months, we're going to expense $500. So from our prepaid insurance, that's an asset, and now it's going down, we're using it up. We're crediting prepaid insurance 500, and we're debiting insurance expense, which is making the insurance expense account go up, but is making equity go down. So in our accounting equation format, we see assets are decreasing under prepaid insurance, and on the equity side, we see retained earnings decreasing because we have insurance expense. So what's left in prepaid insurance? Well, $1,200 minus $500, there should be $700 of prepaid insurance remaining. Does that make sense? That would cover January through July of the following year. Yeah, that makes sense. 7 more months to go. Adjustment 4. As of December 31st, year 2, a physical count of supplies on hand revealed that $125 of unused supplies were available for future use. So first, let's take a look at what they're saying here. They're saying that $125 of supplies are remaining. They didn't tell us how much we actually used up. And remember, we're expensing what we used up. So what they're telling us is that we want the ending balance in our supplies asset account to be $125, but we need to figure out what we have and therefore how much we've used up. So down here we take our beginning balance of 0, we add in $850 of supplies purchased, which gives us $850 of supplies available for use. And if there's $125 of supplies remaining at the end, that means that we used up $725 of supplies. So that's the amount that we want to expense, not $125. So what we're going to do is decrease our supplies asset by $725. So that's a credit to supplies. That's going to leave an ending balance of $125. But we're crediting $725. And then on the other side, we're going to debit supplies expense. So we're debiting the expense account, which is increasing expenses, but decreasing net income, retained earnings, and owner's equity. So again, we've got an asset use transaction. Both sides of the equation are going down, but it's still an adjusting entry in that we don't use any cash, and we're just trying to match our expenses to the correct period. So supplies, the asset, are going down. Retained earnings are going down because we have supplies expense, which creates negative net income. So this is what the textbook gives you to learn your debits and credits. To me, this is a hard one just to look at it and memorize it. I stick with Aid and Lick. I've leaned on Aid and Lick my entire career. But whatever works for you. We need to remember that debits go on the left and credits are on the right, and we need to know how to increase or decrease each account. And for me, Aid and Lick is sufficient, but if you have another way of doing it, use what makes sense to you. You'll see this exhibit in your textbook. I think it looks a little bit better in your textbook because it doesn't have all the grid lines in there. But I kind of like this one in that specifically under dividends and expenses, it reminds you that dividends are actually increasing with a debit, but overall what that's doing is decreasing our retained earnings and our owner's equity. And again, they put the plus under the debit side for expenses, reminding us that expenses do in fact increase with a debit, but then we have to remember that expenses cause net income, retained earnings, and owner's equity to decrease. So the next thing we need to do is learn how to write journal entries. So they say record transactions using the general journal format, which means we need to write journal entries. So here's the basics. When we record a journal entry, we start on the left on the first line with, typically it should be a date, but sometimes in textbook land it's just a transaction number, or it's A, B, C, or it's 1, 2, 3. But typically in the real world, it would start with the date. And then on the first line, you're going to put the account that you're going to debit. Okay, the debit account goes first. And then over to the right, and we put in the first column, the debit column, we put the dollar amount that we're debiting. Then we go to the second line, and they don't do a big indent here, but we should indent several spaces. So this is supposed to be indented a bit. They did just a little tiny bit. I'd like to see a little bit more visually. So we indent the second line, which is our credit account, and then we put the credit in the right column, in the credit column. And even if this didn't say debit and credit here, we know that debits are to the left and credits are to the right. So when we record journal entries, we put the debit account first always. So the first line, and if we had multiple debits and multiple credits in one journal entry, the debits would all go first, followed by all the credits. So debit first with the amount in the left column, the debit column, and then we indent several spaces and we put the credit account with the dollar amount in the right column, which is the credit column. So the format of what we're writing is really critical. A lot of times, especially in your first semester of accounting, I try not to be super critical of format. And if I think you know what you're doing, I don't try to be really picayune about the format. But when it comes to journal entries, the format speaks. And let me show you an example. So if I write a journal entry that looks like this, let's say land 5,000 and cash 5,000. What does that mean? So on the first line and to the left, I have land, which implies that it's a debit because it's first and it's aligned to the left, right? If this is my edge. But then I put the dollar amount in what appears to be the right side. So this is probably debit and credit. So I've put my 5,000 on the first line over to the right. So is that a debit or a credit? And then on the second line, it's the second line and I've indented a bit. So that implies that it's a credit, but then I put my dollar amount under the debit column. So I really can't tell because the formatting here is so bad. We're not really clear. Do we buy or sell land? Which one's being debited? Which one's being credited? The bad formatting is confusing. So that's why it's critical with our journal entries that we write our journal entries with proper format, because the format speaks. The format actually means something. It's not just your accounting instructor being obnoxious and picky. The format is how we read it. So let's try again. Let's say that the first line I put land and 5,000 under debit, and then I indent the second line and 5,000 under credit. So now it looks like land is going up with a debit, cash is going down with a credit. So we bought land using cash. But it easily could have been the other way around given the bad format that I initially used, right? It could have meant debit cash, so cash is going up, and credit land, land is going down. So it could have meant that we sold land for cash. But up here, we've got all kinds of questions. So that's why formatting is so super important when it comes to our journal entries. We have to write them in good format. So here we've got a whole page of journal entries, and I'm sure this is really hard to read. You can probably see it better in your textbook if you'll flip to your ebook briefly. So I've jumped over to chapter 3 in the ebook. I'm roughly on page 160, which is under your table of contents is under the general journal. So I'm on roughly page 160. And what they show here under Exhibit 3.2 is the list of all the transactions and adjustments that we just went through. And then they show each of them in general journal format or journal entry format. This might be an incredibly useful tool for you as you get used to writing journal entries. As you do your homework this week, I would definitely be checking myself by going to this page. This is a great list of transactions and adjusting entries, and they're showing examples of all of that in journal entry format. So definitely visit this page, use it as a tool. And then just below that, they're showing the T accounts. So each of the T accounts that are used in all of those transactions and adjustments, they've got here. I have to scroll over to the right to show them all, but they're all here. What we see when we look at our T accounts, assets have normal balances on the debit side. So in our T accounts, we start with BAL, that stands for balance. So we've got our beginning balance on the debit side. And then at the bottom, we draw a line and we do what's called a foot the T account, which means we add it all up. And for assets, it should be a normal debit balance. They need to carry positive numbers in them, so that would be a debit balance. Now, in doing this, we're adding up all of the debits, and then we're adding up all of the credits, and we're subtracting debits minus credits, and we end up with our ending balance. Now, I do want to point out, you will not see any pluses or minuses, any negative numbers anywhere on this page. There's no negative numbers. Everything is entered as a positive number. If you feel like it's negative, then you move it to the other side and you write it as a positive number. So we don't write minus 26,000, minus 1,200. By being on the credit side of the cash account, those are all decreases to cash. So when we foot the account, we're taking the sum of all the debits minus the sum of all the credits. And whichever side is greater, that's where the ending balance will go. So in looking at accounts receivable, we've got two entries, a debit of 15,760 minus a credit of 13,400. So debits minus credits, we get 2,360, and it goes on the debit side because it's greater. We could do again the same under prepaid insurance. Let's look at a liability. How about accounts payable? We've got 850 on the debit side, and then we've got 850 plus 1,900 on the credit side. So we subtract, we could do debits minus credits, and we're going to get negative 1,900, which means it goes on the other side. It goes on the credit side. It's going to go on whichever side is greater. Some of these accounts they didn't foot at all, like land, salaries payable. Why didn't they foot some of them? Well, the idea is that if there's only one transaction there, you can see what the balance is. You don't need to draw a line and foot it. For me, I'm kind of super type A. I would still draw a line and foot every single account. But the point is that we can see what the balance is in that account. Here, looking at retained earnings, I really want to emphasize this. There is nothing recorded in the retained earnings account other than the beginning balance. Why do you think that is? I'm hoping you said something like, because we haven't closed out the temporary accounts yet. All of the balances from the temporary accounts are going to arrive into retained earnings through the closing process. So right now we're keeping those amounts in their specific temporary accounts, and then each and every one of these revenue, expense, and dividends are all going to be zeroed out and their balances transferred into retained earnings. And we'll get to that in just a bit. So I know this T account format is new for many of you. Trying to think what else students new to the T account format would need to know. Do keep in mind that every account can only have one balance. You don't add up the debit side and put a balance on the debit side and then also put in a balance on the credit side. You only get one balance. And that'll be on whichever side is greater. And again, we don't use any negative numbers. Everything's positive. If you feel like something's negative, maybe you need to move it to the other side. So come back to these couple exhibits in your book. And again, that's exhibit 3.2 that lists all the transactions and then shows all the journal entries below it. And then just below that is exhibit 3.3 showing the exact same thing in T account format. And these pages are an excellent reference for you. So please bookmark those and visit them often, especially if you need help on your homework. So going back to our PowerPoint slides, these are the journal entries that I was just referring to, but we could read them better in the textbook. And again, these are the same T accounts, but again, their grid lines got really ugly and out of control here in PowerPoint. So again, go to the textbook. They're a easier format to read those T accounts and journal entries. Our next topic is the trial balance. The trial balance is essentially a tool that we're going to use between the process of recording transactions as journal entries and then posting those journal entries to T accounts. We use the trial balance as a tool to help us to prepare our financial statements. So the trial balance in itself is not a formal financial statement, but it's an intermediate step that we take. It's a tool that we use to transition from T accounts into our financial statements. And what we're going to do is we're going to list each of our accounts in ALLO order, starting with assets, then liabilities, then equity, and then under retained earnings, we list out all the temporary accounts. So everything that we have a T account for. And if you're preparing a trial balance, you're pretty safe just listing the accounts in the trial balance in the same order that the T accounts are given to you. So we start with our assets. We write down the ending balance in each and every asset account, the ending balance in each liability account. Retained earnings should have nothing but the beginning balance because nothing's gone into it yet. And then we list the balance in each of our temporary accounts. So dividends carry a debit, revenue has a credit, and then each of our expenses has a debit. So we've really just listed the ending balance from each and every T account. And then we add up both columns, the debit column and the credit column, and they should balance. So this is our check to see that our debits and credits balance, to make sure that we haven't made any mistakes in terms of recording debits and credits and analyzing transactions. The trial balance is a great tool because if we find that we're out of balance, we need to fix it now before we move on to preparing financial statements. So let's say hypothetically, you do your trial balance and you come up with, let's say you add everything up and you've got 51,000 in the debit column, 51,260, and in the credit column you have 49,260. So clearly you're out of balance, right? So we don't want to proceed with preparing our financial statements until we get this error corrected. So we've got 51,260 equals 49,260, which is clearly false. So a couple things that I would suggest. First, compute the difference. So what's the difference between 51,260 and 49,260? The difference of 2,000, right? So now take that difference, 2,000, and divide it by 2. Divide it by 2. So we get 1,000. So in this case, we would want to scan and look through our records, our T accounts, our journal entries to see if we recorded something that was $1,000 in the wrong column, if we wrote a credit down as a debit or vice versa. And in my example here, essentially what was happening is that we accidentally put the 1,000 of retained earnings in the debit column. And that would create a $2,000 difference, because we're increasing our debits and decreasing our credits by 1,000 each, creating this difference of 2,000. So when we fix that and we move it back to where it belongs, debits go down to 50,260 and credits go up to 50,260. So anytime we put a debit or credit on the wrong side, it's going to create double the difference. So we always want to find our difference and divide by 2. If that doesn't work, here's another trick for you. Find how much you're off by, that difference, and divide it by 9. When we divide by 9, it reveals 2 different possibilities of errors. One is what we call a slide error, and the other one is a transposition. A slide error is when we essentially put the decimal point in the wrong place, meaning we put too many zeros or too few zeros, or we move the decimal place over. So if I write down 10 instead of 100, I've dropped a 0 off, right? I write down 10 instead of 100, my difference is 90, right? Between 10 and 100. So I'm looking for, if I come up with 90, we know that's evenly divisible by 9, and also a factor of 10, which kind of clues me in on what I might be looking for. What if I write down 2,000 instead of 200? What's the difference? 1,800, right? The difference between 2,000 and 200 would be 1,800. Is that evenly divisible by 9? Yep. And a factor of 2. So again, it clues me in on what I'm looking for. So it doesn't matter how big or how small or how complicated these numbers are. Anytime we put the decimal point in the wrong place, oftentimes adding or dropping zeros, it's going to create a difference that's evenly divisible by 9. So that's a slide error. A transposition is when we swap any numbers. We switch any 2 numbers. So if I write down 45 instead of 54, the difference is 9. Okay. What if I write down 73 instead of 37? What's the difference? 73 versus 37, that's a difference of 36, which is evenly divisible by 9, and a factor of 4. So I'm looking for numbers that are different by 4, like 3 and 7 are different by 4. And this goes, it doesn't matter which digits we transpose. So let's say under supplies expense, I write down 500, supplies, I write down 527 instead of 725. What's the difference? $725 minus 527, we've got a difference of 198, which is evenly divisible by 9. And so then that's a larger one, but if you want to get really into it, 9 times 22, so we're looking for something that's different by 2. 5 and 7 are different by 2. So we can use this tool of dividing by 9 to really clue us in on what to look for without having to go back and redo all of our work, double check all of our work. So it can kind of point us in the right direction in finding our errors. So hopefully that will help you. If you do your trial balance and you find out that you don't balance, then it's your job to figure out what happened. So hopefully these tools will help you out. Again, first find the difference and divide by 2 and look for that amount in the wrong column. So you put a debit in the credit column or vice versa. If that doesn't work, take that difference, how much you're off by, and divide it by 9. And then we're looking for a slide error or a transposition. So next we want to use our trial balance to help us prepare our 4 financial statements. What are the 4 financial statements? Which one do we do first? We're going to do our income statement first. So everything we need for the income statement is right down here. Revenue minus expense is going to give us net income. And so we see revenue over here as a credit, and then we have all of our expenses right here as debits. And we're going to move right into our income statement. I do want to emphasize that when we have columns on our financial statements, particularly the income statement and the balance sheet, but really any of them, there are no debits and credits in financial statements. So we could have done this whole income statement in one column. This is not showing credit of $17,260. Now you and I happen to know that revenue is a credit, And then they put salaries, other operating insurance, and supplies. So they're providing all the detail of the expenses in the left column, but they're not there because they're debits. So we sum up all of our expenses, and we get 17,260 minus 13,425 is 3,835. I do want to point out on this slide, they made all of their expenses negative numbers, putting parentheses around them. I'm not going to say that's horrible and wrong, but I don't prefer it. Those expenses are positive expenses, and the formula is already revenue minus expense equals net income. So if you want to be real technical, they're saying 17,260 minus negative 13,425 equals 3,835. Well, we know that's not very good math, so I don't agree with these expenses all being negative, but we do see what they mean. So as long as we understand what they mean, I suppose it's okay. Statement of changes in equity. Where are we going to get our data for this statement? I mean, here's the statement, but where do we find all this data? Is the trial balance really all that useful? Not really for this one. I would go to the T accounts, to be honest with you. So we're going to go back to our T accounts. And again, I don't love their T accounts here. They're hard to read because their grid lines are too big. But we can get what we need. So the statement of changes in equity is going to run through common stock and retained earnings. So we're going to say my common stock started with 4,000, and then we issued another 25,000 in stock, and therefore we end with 29,000. Retained earnings, we're going to say my beginning balance was 1,000, and then I'm going to add my net income from the income statement that we just did, and then I'm going to subtract the dividends, and we'll arrive at our ending retained earnings. So that's what this statement is showing. So the trial balance is not super useful. I would go back to the T accounts to help you with your statement of changes in equity. How about the balance sheet? Where should we find our data for the balance sheet? Now we can go back to the trial balance, right? Now it's useful again. So I would grab all of this, all the way down to there is fine. Why did I not include retained earnings though? That retained earnings there is our beginning balance. We're going to need to get our ending retained earnings balance from our statement of changes in equity. So all of this is fine for assets, liabilities, and even common stock. And sometimes I'll say, just take your assets and liabilities. So even just stop right here and then grab the other numbers from your statement of changes in equity. This is your equity section of the balance sheet right there. And then you're ready to do your balance sheet. And again, it looks like they've prepared it in two-column format. That is not debits on the left and credits on the right. Remember, you learned financial statements long before you learned debits and credits. So what they're showing is the detail of all the assets on the left, and the sum is over to the right. The details of the liabilities on the left, and the sum is over to the right. The details of equity to the left, and the sum is over to the right. So what we see is that assets, 36,035, equal liabilities plus equity, 3,000 plus 33,035. And we see the total, 36,035. And we've double underlined both of those, saying, yes, they balance. And we're showing assets, liabilities, and equity. So our balance sheet, again, is not debits and credits. It's just showing that the balance in each of our ALLO accounts balances out. So our accounting equation works. Then our last financial statement is the statement of cash flows. Where should we find data for that? Does the trial balance help? Well, we get one tidbit from there, just the ending balance in cash, but that doesn't really help us too much with the statement of cash flows. So really, to do the statement of cash flows, again, you're going to need to go back to the T accounts. And I really like doing a statement of cash flows using T accounts, because what we have right in front of us, we've got our beginning cash and our ending cash. So before we even get into it, beginning cash and ending cash, 5,000 versus 6,850. What's our net change in cash? Should be 1,850, right? 1,850, the difference between the beginning and ending. And then everything that's on the debit side of the cash T account is going to be an inflow or an increase to cash. And everything on the credit side, on the right side, is going to be an outflow, a decrease to cash. So let's run through these cash flows real quick. All right, so starting with the debits, I see 25,000 on the debit side in cash, and that was from issuing stock. So that's FA. I'm just going to write an F. Ooh, that's a really ugly F. Try again. I'm going to write an F. Okay. Then we've got an inflow of 1,800, which I believe that was from unearned revenue. So that's money in from customers. That's an OA. Then let's see, we've got an inflow of 13,400. That was from accounts receivable. So again, that's money in from customers. That's OA. So that's all of our inflows. Let's go over to the credit side and look at our outflows. We have a $26,000 outflow that was for the purchase of land. So that's IA. Oh, that's an ugly I. Try again. Okay, that's an I. Then we have a $1,200 outflow. I think that was prepaid insurance. So prepaid insurance would be OA. Then we have a $9,500 outflow that was for salaries, paying our employees. That's OA. And then we have an $800 outflow that was for paying dividends. So we're paying the financiers, the stockholders of our business. So that's FA. And then we have an $850 outflow that was to pay down accounts payable. So we're paying our bills. That's OA. So now we've labeled all of them. We just need to organize them into the three sections on the statement of cash flows. Again, I want to remind you, start at the bottom. Beginning balance, ending balance, net change. So let's go straight to the bottom of our statement of cash flows. And we see beginning balance, ending balance, and our net change of 1,850. And then we organize everything into OA, IA, and FA. So it's really important to go back to that cash T account and label each of those items, use them once and only once as we prepare our statement of cash flows. And then what we find out is that if we sum up OA plus IA plus FA, it also verifies 1,850. So we've accounted for all of our numbers and classified them in the right categories. I hope the statement of cash flows is starting to feel a little bit better for you. Typically, that's the one that students struggle with the most. So keep working it. Really use that cash T account and use only what's in the cash T account. Every number from the cash T account is going to get used once and only once. So we've got our beginning and ending balances at the bottom. We compute the net change in cash, and then we use all of the inflows and outflows in their OA, IA, FA categories, and we confirm 1,850. All right, our next task, we need to learn how to prepare closing entries in general journal format. And I have to be really honest with you. Here, this is what the book gives you. There, now you know how to do it. Here they are. I feel like they don't really teach you how to do the closing entries. They just show you the closing entries, which is a little bit different than actually learning how to do it. So we need to actually look at the T accounts. We want to look at the T accounts. That's my favorite place to go for closing entries. In fact, I'm going to jump back over to the textbook. All right, here we are back in the textbook. We're at exhibit, well, it was 3.2 up here, and then we have our T accounts below in 3.3, I believe. So we see each of our temporary T accounts, and we've got our retained earnings. And remember, the objective of closing out our books is to reset the temporary accounts to 0 and transfer those balances into retained earnings. So what we want to do here is take each and every temporary account. We'll start with service revenue. I won't go through every single one of them. I just want to show you an example. I'm going to jump back to the slide so I can draw a little bit. So we're going to draw a retained earnings account. Here's retained earnings. And it had a balance of 1,000. And then we'll draw our revenue account. I think it was consulting revenue. And our balance was, I think it was 17,260 on the credit side, of course. So we've got 17,260. Okay, so the question, how do we make the balance in revenue, consulting revenue, go away? Well, to make it go away, we're going to have to debit revenue, 17,260, and then we're going to need to credit retained earnings, 17,260. And typically next to closing entries, we write CL, which stands for closing. So we've literally moved that amount from revenue into retained earnings, and now our balance in revenue is 0. Okay, let's try an expense account. Let's choose, doesn't really matter which one we go with. Let's do salaries expense. It's got a debit balance of 10,300. So we've got salaries expense with a debit balance of 10,300. So to make that balance of 10,300, oh, that is an ugly 3, 10,300 go away. So we have a debit balance there of 10,300. To make it go away, we're going to need to credit 10,300. So if we credit there, that means we need to debit retained earnings. And again, we write CL next to our closing entries to show that they're closing. And that would leave us with an ending balance of 0 in salaries expense. And we can literally connect our dots and draw a line to where those numbers are going. We would do that for each of our expenses. We can also do dividends. Let's see, we've got dividends. I think it was 800, right? 800 on the debit side. Yes, 800 on the debit side. And if we're going to wipe out dividends and make it go away, then we need to issue a credit of 800. And if we're crediting there, then we need a corresponding debit, which we'll put 800 here. And again, CL, because those are closing. And that leaves us at 0 in dividends, and we can see where it went. Now, we'll do this for every temporary account, revenue, expenses, dividends. And what we see, I want you to think about it. When we close the revenue account, it caused us to debit revenue and credit retained earnings, causing our retained earnings to increase. Is that what you thought revenue was ultimately going to do to retained earnings? Yeah, I hope so, that revenue increases retained earnings. How about when we close out salaries expense or any expense? In order to close it out, we had to credit the expense account and then debit retained earnings, which that makes retained earnings go down. Is that what you thought expenses would do to retained earnings? I hope so. Expenses are going to bring down our net income, retained earnings, and owner's equity. And again, the same with dividends. To make the dividends go away, we had to credit dividends and therefore debit retained earnings, making retained earnings go down. And again, when we pay out dividends, that's taking away from our retained earnings. So what we're seeing now is finally the whole conversation we've had about the impact of these temporary accounts on retained earnings and now we're actually doing it. So going back to the closing entries that the book gives us, now hopefully this makes a little more sense. Where is all this coming from? Well, we had to wipe out service revenue with a debit, and we're crediting retained earnings. We had to wipe out salaries expense by crediting and therefore debiting retained earnings. And we do the same for each of the other expenses. And then at the bottom, we have to wipe out dividends with a credit, and then we're debiting retained earnings. I can tell you in your homework, a lot of times the book wants you to do your closing entries in just 3 entries. One for revenue, one for all of your expenses, and one for dividends. Sometimes they even want you to combine the expenses and dividends. And ultimately what you would be doing is just doing a big giant debit to retained earnings, just one of them, and then credit each of the expense and dividend accounts. So you'd skip all of those ones. You'd have one big debit to retained earnings, and then you would credit salaries expense, other operating expense, insurance expense, supplies expense, and dividends. Sometimes they even want you to do it as one entry, which they show here. So we go through and we debit and credit every single temporary account, and then we compute the mathematical difference to make our journal entry balance, which is 3,035. Does that number look familiar to you at all? 3,035? I want to go back to our statement of changes in equity. So on our statement of changes in equity, if we take our beginning retained earnings of 1,000, and then if we look at net income minus dividends, guess what that is? 3,035. So if we take 1,000 plus 3,035, we arrive at our ending retained earnings. So by the time we record our closing entries, we're going to arrive at a balance of 4,035 in our retained earnings T account, which is going to match to our statement of changes in equity, and it's going to match to ending retained earnings on the balance sheet. This exhibit is talking about the fiscal closing dates of different businesses, and this is based on some survey that they did. And what they're referring to is, when is year end? And for most companies, the answer is December. Most companies close their books at the end of December. They operate on a regular calendar year. But some companies opt to choose different closing dates, and that's what we call a fiscal year end, a fiscal closing date. And a company can opt for really any date that they want. So there's a good number of companies that choose June 30th, halfway through the year. So their year would run from July 1st to June 30th of the following year. A lot of companies choose September. And there's a few reasons companies might do this. Some companies feel that they're just too busy at the end of the year, December and January, to deal with closing and all the work that goes into year end. Especially a lot of retailers, that's an incredibly busy time for them, so they would prefer not to have their year end in December. So it has to do with the seasonality of businesses and what the company prefers. Some of them will choose other month ends, but I mean, you could literally choose any date that you want. If your favorite day of the year is April 13th, then you can run your accounting from April 14th of one year and close it on April 13th of the next year. So it's entirely up to you. Most businesses can choose fiscal closing dates, not all, so I don't want to say every company can choose that. But it's really up to the business to make that decision. And there might be a variety of reasons why, including seasonality. But it's also good that not all businesses close in December, because it would be pretty overwhelming for accountants in terms of doing tax returns and closing books. It's already overwhelming as it is. Imagine if all these other companies that choose other fiscal year end were also in December. It would become more overwhelming. So that's fiscal closing dates. Finally, I want to show you what's called a post-closing trial balance. So this is what our trial balance would look like after we close out all of the temporary accounts into retained earnings. So notice it's a shorter trial balance. There's nothing under retained earnings. That's our last account there. And look at what the balance is, 4,035, right? The same balance that we would see on our balance sheet. So the post-closing trial balance is the same as our regular trial balance, except all of the temporary accounts have been rolled up, have been closed out into retained earnings. So it's going to appear a bit shorter. All right, so what you're going to find at the end of each chapter moving forward, we're almost always going to be talking about some financial ratios. Financial ratios are important in that they help us to compare our numbers. When we look at numbers just at their face value, they don't have a lot of meaning until we compare them to something else. So we want to compare different numbers to one another to see how we're doing. And we can even compare our financial ratios from one year to the next, or even to other companies. So our first ratio that we're going to learn is the return on assets ratio. And what we're doing here is evaluating the company's performance, but in doing so, we need to consider the size of the investment base used to produce that income. So if I told you, hey, guess what? My business had net income of $1 million. Is that good or is it bad? Well, I mean, yeah, $1 million. I mean, that sounds like a lot. That sounds good, right? But what if I told you I used $1 billion of assets to do that? That's not very good. So we want to compare our net income to our total assets. So let's say I've got $1 million of net income. That's a lot of zeros for me to draw. And let's say I had total assets of $1 billion. That's even more zeros for me to draw. What's my ratio? That equals 0.001. Well, I'm happy about my $1 million of net income, but if I used $1 billion of assets to generate that, quite honestly, that's pathetic. We could actually earn more than that by just parking our money in a savings account at the bank. So that's not good. What if I told you, though, I have net income of $1 million and I had total assets of $1 million? Those are all zeros, not sixes. So then my ratio is just 1 to 1, right? It's 1. So that's good. I used $1 million of assets to generate $1 million of net income, and now I still have those assets to help me generate income next year. So that looks good. But what if I told you that I have $1 million of net income and I generated that using $100 of assets? Wow, that's really good, right? So this exhibit 3.10 is showing us fiscal closing dates. They're referring to different fiscal year ends. Now, a lot of times we just assume that all companies end their year in December, a calendar year end, December 31st. But the reality is some companies, not all companies, depending on the type of company they are, have the option of choosing a different year end, what we call a fiscal closing date. So while most companies do stick with December 31st, a calendar year end, some companies will choose other dates. June 30th is a popular one. September 30th is another popular one. But really, they could choose any date. If your favorite day is April 13th, you can make that your year end. So your year would begin on April 14th and end on April 13th of the following year. Obviously, that's not extremely common, but the reason some companies choose to do these things are because of their business cycle and also the seasonality of businesses. A lot of businesses are super busy during December and January, so it's not a great time to work on year-end things. So there's a lot of work that goes into year-end in December, and then a lot more work that happens in January. So a lot of retailers choose not to use a calendar year end. Some of them will choose January as their year end, or maybe May or June. but it's up to each company. And it's a good thing because if everybody closed their year end all in December, it would be somewhat overwhelming for accountants and even the IRS. It's just a lot. So it's already a lot with most businesses closing in December. Imagine if everybody closed in December, it would make it that much worse. Here we're looking at what's called a post-closing trial balance. And a post-closing trial balance is just like a regular trial balance, except it doesn't have any temporary accounts. Why? Because they've been closed out into retained earnings. So all of the temporary accounts were closed into retained earnings through the closing process, and our retained earnings ends up at 4,035. That number should look familiar, right? That's what we computed our ending retained earnings to be in our statement of changes in equity, and that's what we used on our balance sheet. So post-closing trial balance is simply your trial balance that's remaining after closing out all the temporary accounts. Next, we're going to take a quick look at some financial ratios. You'll find that at the end of most chapters from here on out, we're going to study a couple of financial ratios. And the purpose of financial ratios is to help us understand the numbers on our financial statements better. Numbers by themselves don't tell us a lot. Numbers come to life when we compare them to other numbers. We compare them to other things. So for example, if I told you I made $1 million last year, is that good? Is that bad? I mean, it's $1 million, so sounds like something's good. But what if I told you I made $5 million the year before? Now $1 million doesn't sound so good anymore. Why did I go down from 5 million down to 1 million? Or if I told you how much I had in assets in order to make that $1 million. Let's get into these ratios and we'll start understanding how the comparison of numbers helps us understand our financial situation better. So our first ratio is return on assets ratio. And with this ratio, we're going to be evaluating the performance of the company while considering the size of the investment base used to produce the income. So the example I was just referring to, what if I have $1 million in net income, which sounds cool, right? $1 million of net income. But what if I had $1 billion in assets in order to generate it? That's a lot of zeros. $1 million of net income divided by total assets of $1 billion. What's my ratio? We've got 0.001, right? I think we could make more than that by just putting our $1 billion in a savings account at the bank. So $1 million of net income is kind of pathetic. What if I have $1 million of net income based on $1 million in assets? That's a comma. So now my ratio is just 1. So I have equal amounts of net income and assets. So I used my assets somewhat efficiently to generate net income, and now I still have $1 million of assets to keep generating net income next year. What if I have, let's go extreme. What if I have $1 million in net income and I have only $10 in assets? Well, it tells us below, this ratio measures the relationship between the level of income and the size of the investment. A larger ratio means the company did a better job of managing its assets. Well, that's good. Larger means better job managing its assets, but this would be an extremely high ratio. Why do I have $1 million of net income and only $10 in assets? That's really concerning. So it's awesome that we're able to use only $10 in assets to generate $1 million of net income, but what happened to the rest of our assets? Where did they go? If you have that much income, how come you don't have any assets to show for it? Maybe the answer is we paid it all out in dividends. But that seems like maybe we paid out too much dividends if we've left ourselves with only $10 of assets. So I'm a little bit concerned about this one. when we see extremes in our ratios, I know it says larger is better, but anytime we see extremes, we need to be cautious when it comes to our ratios. That's a little bit too extreme. Our ratio would come out to 100,000. I'm writing right off the edge of the screen. It's 100,000. That would be definitely an extreme and something that I would be super skeptical about. But again, we see a healthy ratio at 1 or maybe 1.5 or 2. That's a nice healthy return on assets ratio. But when we get into an extreme like 100,000, I'm a little bit worried. Let's take a look at debt to assets ratio. Anytime we borrow money, there is an inherent debt risk. So borrowing money comes with debt risk. And that risk is, are we going to be overburdened by paying down our debt by making the payments on it plus interest? So this helps the company to evaluate the level of debt risk. And a smaller ratio indicates that there's less debt risk for the company. So if we start with debt, by the way, is liabilities. So we can say our total liabilities divided by our total assets. So we have liabilities of 100,000. I'm writing super sloppy here, sorry. Let's do that again, 100,000 and assets of 100,000. Then our ratio just equals 1, right? We have equal parts of liabilities and assets. But what does that tell us about our equity? If we have assets that equal liabilities, that means our equity is 0. Is that too much debt risk then? Do we have enough assets to pay our debts as they come due? 1 is where we say it's too high. Once we get to debt to assets ratio of 1, that's too high. So let's look at maybe a healthy debt to assets ratio of 50,000 divided by 100,000. Those are all zeros, not sixes. So our ratio would be 0.5, right? So that's a healthy debt to assets ratio. And again, if you think about our accounting equation, if we have 100,000 assets, 50,000 liabilities, we must also have 50,000 in equity, meaning our company is half financed by debt and half financed by equity. And that's pretty healthy. So to me, a healthy debt to assets ratio would be somewhere between 0.5 and 0.8. If you get lower than 0.5, it might be a little too conservative. Let's say we only have $1 of debt for $100,000 in assets. So essentially we have no debt, right? Maybe that's a little bit too extreme. Investors might not like that if we're not taking advantage of what we call positive financial leveraging, which we'll talk about in just a little bit. So if we do 1 divided by 100,000, I think that's 0.00001. So that's really extreme. Essentially, we have no debt. So while according to this, a smaller ratio indicates that there's less risk, having virtually no risk isn't always the best course of action. So we do want to take on a responsible amount of debt risk. So of these ratios, I like 0.5 the best. Again, I would like 0.5 to 0.8. And then we take a look at return on equity ratio. This one is commonly looked at by investors or stockholders, and they want to know, are we efficiently using their investment to generate net income? So a larger ratio indicates that the owners have a higher return on their investment. So the company is wisely using those investment dollars to generate net income. And again, we could use kind of the same numbers. If we've got net income of 100,000 divided by stockholders' equity of 100,000, our ratio is simply 1, and that's fine. And this ratio will vary a lot by company, depending on the amount of equity versus liabilities they have. So it's hard to say what's good or bad, but what we do know is that larger means that they have a higher return on investment. So if we had $200,000 of net income based on $100,000 in stockholders' equity, then our ratio goes up to 2. And so again, net income over stockholders' equity, and this one can vary a lot depending on how much equity there is in a company. So most likely we'd want to compare this with ourselves, with our own company year after year to see if we're generating more return on investment. Stockholders versus creditors. Stockholders like a lot of debt if the company can take advantage of positive financial leveraging. I want to be careful with that phrase, a lot of. Financial leveraging is the idea of borrowing money to make money. And put simply, the way I like to explain positive financial leveraging is, why should I use my money to make money for me if I can use your money to make money for me? So meaning if I could borrow money from you at 4% and turn around and use that money in my business to make 8%, then I'm coming out ahead and I don't have to put my own money in. So I can borrow money and do something with it. So that would be positive financial leveraging. And they're suggesting stockholders would prefer that we take advantage of that they like a lot of debt if we're using positive financial leveraging. So I want to be careful with a lot of. We want to have a healthy amount of debt, not an overwhelming amount of debt. What if I thought I could make 8% on it, but it turns out I can only make 6%? So I'm borrowing from you at 4% and I'm only making 6% on it. What if the economy suddenly turns around and is doing really poorly, and I borrow from you at 4% and now I'm only making 3% on that? Now are we happy about having a lot of debt? No. So anytime we take on debt, we need to be responsible. We want to take on debt in moderation that we can handle. But it is smart for a business to take advantage of positive financial leveraging. Creditors, on the other hand, prefer less debt and more equity because that equity represents a buffer of protection. The creditors would prefer to be our only creditor. They want to make sure that they get paid back plus interest on time. So the idea of having lots of debt means there might be other creditors, and that makes them a bit insecure. So both stockholders and creditors want the company to be successful. They want them to have net income, but in terms of where they get additional financing from, they differ a bit. So if the company says, hey, we need a whole lot of cash, should we issue stock or should we borrow more money? The stockholders are going to say, borrow money, take advantage of that positive financial leveraging. Creditors are going to say, no, don't borrow any more money. We want to be your only creditor. Go ahead and issue more stock. Why would stockholders not like it if you issue more stock? Well, we're going to talk about it more later, but I'm going to just throw the idea out there. It dilutes their ownership in the business. So if they have to share their ownership in the business with more investors, it essentially takes their share of the company's net income and it chops it down. It slices that pie a little bit smaller. We'll talk about that more in a future chapter. Here they give us some ratios for some real-world companies. Notice they've separated it into industries, that we try not to compare companies across different industries because they operate a lot differently. They have different operational assets. They might have different requirements in terms of what they need, also different regulations potentially. So in looking at these, it's a good exercise to go through and remember what's better. So when it comes to debt to assets, do we want a higher or lower debt to assets ratio? Typically we want something under 1. I think I told you earlier, I like debt to assets to be 0.5 to 0.8. Most of these, for these insurance companies, are fine with me. 88, this is percent, 0.88 or 88%. That's a little bit high, but they're all okay. Of these, Aetna has the least debt risk. How about return on assets? For return on assets, we want a higher number. So greater net income relative to our total assets. So all of these are okay. 2.6 seems to be on the low end, but Progressive's looking pretty good. And then return on equity, again, we want a higher number. Now Aflac has the highest one, and Aetna the lowest, and Progressive kind of in the middle. So all of these are somewhat healthy, but we need to compare them year over year. But if I had to just pick one of these companies to invest in based on what I see here, I would probably go with Progressive. But we can make arguments for any of them. If we look at these oil companies, now keep in mind, look how different their debt to assets ratios are. So different expectations in a different industry. All of these are plenty low and healthy. So that's fine. They're all under 0.5, so even a little on the conservative side. Return on assets, Chevron and ExxonMobil are somewhat close, and then Marathon, that's the smaller company than Chevron and Exxon, a little bit more of a new up-and-coming company, probably less heard of. Their return on assets is significantly lower at 4.9. And then we look at return on equity, and Chevron is in the middle, Exxon is the highest. Again, we want higher numbers here. And then Marathon's trailing way behind again. So initially it looks like Marathon might be the weakest of these companies, but then if we're considering investing in something, do we want to invest in a company who's already made their money, that they've already been highly successful? Yeah, we could invest in that and continue to see that company grow and do well. But sometimes we want to look for a new and up and coming company, a company whose story has yet to be told, might have a little more risk with it, but if the company really succeeds and takes off, we stand to make a lot of money on our investment. So of these three, if you want to take a little bit of a risk, investing in Marathon might be a smart idea to see if they grow and become highly successful. So we'll talk more about the stock market and financial ratios throughout the semester. This is just an introduction to that, and we're just going to kind of build a toolkit of a variety of different financial ratios and be able to use those later in the semester to analyze companies and financial statements. All right, that is the end of Chapter 3. Study and practice those debits and credits, T accounts, and journal entries, and you guys know where to find me. I'll talk to you soon.